Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, July 31st. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Just a few months ago, two scenarios seemed improbable: Goldilocks economic conditions and a soft landing. Anyone who posited such hopes were mostly derided by the Wall Street consensus as deluded Pollyannas. No longer, bearish sentiment is increasingly hard to find. We're witnessing resilient economic growth combined with cooling inflation. The jobs market remains healthy, but it's slowing. Corporate profits are under pressure, but Q2 results so far have been surprising on the upside. Last week, the major U.S. and overseas stock market indices closed out another winning week. Take a look at the following chart. For the week ending July 28th, the Dow Jones Industrial Average rose 0.7%, the S&P 500 rose 1%, the tech-heavy Nasdaq rose 2%, and the EAFE rose 0.7%. The benchmark 10-year Treasury yield stayed below 4%, only inching up 0.1%, and crude oil prices jumped 4.4%. The Dow posted a winning streak of 13 consecutive sessions, which ended when it fell last Thursday. The S&P 500 has risen 19.3% year-to-date as of market close July 28, putting the index less than 5% from its all-time high reached in January 2022. What's particularly encouraging is the rally's increasing breadth. The New York Stock Exchange Advanced Decline Line, the NIAD, has risen well above its major moving averages, which signals a broadening of the rally. It's not just the mega-cap technology stars that are driving this rally. The upswing is spreading to smaller businesses that are cyclical in nature. Second quarter earnings results have been surprising on the upside. For Q2 2023, with 51% of S&P 500 companies reporting actual results, 80% of S&P 500 companies have reported a positive earnings surprise, and 64% of companies have reported a positive revenue surprise. Encouraging inflation reports have been boosting stocks. The U.S. Bureau of Economic Analysis, the BEA, reported last Friday that the Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditures PCE index, decelerated in June despite resilience in consumer spending and jobs growth. The PCE index rose 3% in the 12 months through June, in line with consensus expectations. That level was a slowdown from 3.8% of the previous month. After excluding the volatile components of food and fuel, the core PCE rose by 4.1%, slightly less than expected. That's considerably lower than the peak of 5.4% in 2022, and it represented the lowest reading since September 2021. The BEA also reported last Thursday that U.S. gross domestic product, GDP, adjusted for inflation, climbed at a 2.4% annual rate in the second quarter of 2023. That level was up from a 2% growth rate in the first 3 months of the year and much faster than economists had expected. The Fed's policy-making Federal Open Market Committee, the FOMC, last week lifted interest rates to a range of 5.25% to 5.50%, the highest level since 2001. But the betting on Wall Street is that the Fed will reverse course and cut rates in March 2024, a move that probably would trigger a huge relief rally. To be sure, we'll get a pause before a cut. But there's good news if you're a patient investor. Since 1989, stocks have strongly rallied soon after the hiking cycle has ceased. Now let's take a look at the week ahead. The following economic reports are scheduled for release in the coming days, and it will be a busy week of data indeed. S&P final manufacturing PMI, job openings, ISM manufacturing construction spending Tuesday, ADP employment Wednesday, initial jobless claims, U.S. productivity, S&P final U.S. services PMI, ISM services factory orders Thursday, U.S. non-farm payrolls, U.S. unemployment rate, and U.S. hourly wages Friday. If you had listened to the bears this year so far, you would have left a lot of money on the table. That said, the markets remain uncertain, and a major surprise could still derail the rally. If you're looking for a way to generate reliable income with mitigated risk, consider our premium trading service, Rapier's Income Accelerator, helmed by our income expert, Robert Rapier. Robert can show you how to squeeze up to 18 times more income out of dividend stocks with just a few minutes of work each week. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any comments or feedback, please don't hesitate to send an email to me at mailbag@investingdaily.com. Thanks so much for watching.